Welcome to the deep dive. Today, we're cutting through the noise and taking a direct path to being well informed on a specific part of the tax code that just might put some money back in your pocket. Because let's be honest, finding those hidden tax savings feels like uncovering buried treasure, doesn't it? Our mission today is to truly unpack and understand the credit for the elderly or the disabled. It's found on IRS Schedule R. And this isn't just about, reading a form. It's about uncovering a very precise, direct tax benefit designed for individuals who meet certain age or disability criteria. What's truly fascinating about Schedule R isn't just that it saves money, but how specifically it targets relief. It's like finding a microcredit designed for a very defined group. And understanding those nuances is where the real power of this deep dive lies for you, or perhaps for someone you care for deeply.
Precisely. While the world of tax forms can certainly seem, well, daunting and full of specialized jargon, our goal today is to really pull back the curtain on Schedule R. Understanding this particular credit can lead to significant tax benefits, directly reducing your tax liability dollar for dollar. We're going to dissect exactly who qualifies, how to navigate the form step by step, and what critical details you absolutely need to pay attention to. Making sure you're eligible and don't leave any money on the table.
And that's why we wanted to bring this deep dive to you, our listener, because this is where the rubber meets the road for your finances. Whether you're directly affected by age or disability, you're caring for a loved one who might be, or frankly, you're just fascinated by the intricacies of the tax code and uncovering those unique savings opportunities. Well, this deep dive will arm you with the precise knowledge you need to understand this credit and potentially claim it. Let's get right into it.
Okay, let's unpack this. When we talk about Schedule R, Form 1040, what exactly are we looking at? At its core, it's the specific form the IRS is designed to help you figure out and claim the credit for the elderly or the disabled. But why does this particular form and this credit matter so much in the grand scheme of tax savings?
It's a vital distinction, and it really comes down to the fundamental difference between a tax deduction and a tax credit. For many of you seasoned filers, you already know the power of a tax credit, how it directly reduces your tax bill dollar for dollar, unlike a deduction that just lowers your taxable income.
Right, the deduction just shrinks the amount you get taxed on. Exactly. So if you have a $100 deduction, you might save, I don't know, $10 or $20 depending on your tax bracket. But if you have a $100 credit, your tax bill goes down by, well, $100. This is a direct reduction of your final tax liability, making it an incredibly powerful tool for tax savings. It's one of those provisions that truly puts money back into your pocket, rather than just reducing the amount that's subject to tax.
So it's not just about lowering a number on a line, it's about directly cutting the bottom line you owe. That's a significant financial impact, yeah. Now, I understand there's been a subtle but welcome change to how the IRS provides information for this credit.
Absolutely. What's fascinating here is how the IRS has tried to streamline the process, which, as you know, is a rare but very welcome development in the world of tax compliance. For a long time, taxpayers had to refer to a separate publication, Publication 524. It was solely dedicated to the credit for the elderly or the disabled. It was an extra step, an extra document to cross-reference. However, starting with the 2024 tax year, Pulp 3024 has been discontinued.
Oh, that's a small victory for sanity right there.
It really is. All the pertinent information that was once in that separate publication has now been incorporated directly into the instructions for Schedule R itself. So the implication here is pretty significant for you as a taxpayer. You no longer need to jump between documents. The Schedule R instructions are now your primary, all-inclusive source for understanding this credit. This streamlines the process and hopefully reduces some of that typical tax form frustration. And as always, for future developments or any, last-minute legislative changes, the IRS always directs you to irs.gov scheduler. That's always a good place to check right before you finalize your return.
That's a practical tip right off the bat. So if Schedule R is our treasure map, the first crucial landmark, perhaps the most critical checkpoint, is answering, am I even on the map to begin with? The IRS has incredibly precise definitions for who can even think about claiming this credit. It's not a universal benefit. What are those fundamental gatekeepers to eligibility?
There are essentially two core requirements you absolutely must meet. First, you need to be what the IRS calls a qualified individual. And second, your income, both taxable income and certain types of non-taxable income, must not exceed specific limits. Think of it as a two-stage filter, maybe. You first use Figure A, found within the Schedule R instructions, to determine if you're a qualified individual. If you pass that, then you move to Table 1, also in the instructions, to check if your income is within the allowable limits. You really need to pass through both gates to claim this credit.
So let's dive into that first gate. Being a qualified individual, what does that truly entail?
Okay. The general rule is pretty straightforward. You must be a U.S. citizen or a resident alien. This credit is fundamentally designed for individuals who are fully participating in the U.S. tax system. However, there are important exceptions to this U.S. citizen or resident alien requirement that are definitely worth noting, particularly for those in unique immigration situations. If you are a non-resident alien at the end of the tax year, but you're married to a U.S. citizen or a resident alien, you might be able to take the credit. This is if, and it's a big if, you and your spouse choose to be treated as U.S. resident aliens for tax purposes.
That sounds like a significant election. What are the implications of making that choice? Does it affect other things?
It is significant, yes. If you make this choice, it's critical to understand that both you and your spouse will then be taxed on your worldwide incomes, not just U.S. source income. It's a very specific election, so it's something to discuss thoroughly with a tax professional if it applies to your situation. For those intricate details, the IRS directs you to Pub 519. That's their comprehensive guide, specifically for U.S. tax guide for aliens. Think of it as your deep dive into the very specific tax world of non-citizens. Also, it's important to note right off the bat that you can only take this credit if you file Form 1040 or 1040-SR. You absolutely cannot take it if you file Form 1040-NR, which is specifically for non-resident aliens not making that election. Okay, so once you meet that U.S. residency or citizenship requirement, you then need to meet one of two primary criteria based on age or disability. The first criterion is generally the simpler one. You are age 65 or older at the end of 2024. Now, the IRS has a very specific definition of age 65 for tax purposes, and this detail often surprises people. You are actually considered 65 on the day before your 65th birthday.
That day before your birthday rule?
Yeah.
It sounds like a trivial detail, but yeah, it can be the difference between qualifying and not. It's a prime example of how precise the IRS can be with its definitions, isn't it? It means for January 1st birthday, you're actually considered 65 on December 31st of the previous year. That simplifies things for the tax year end.
Exactly right. For instance, if you were born on January 1st, 1960, you were considered to be age 65 at the end of 2024 because you would have reached 65 on December 31st, 2024. This seemingly small detail can be crucial for determining eligibility. There's also a special rule if you're preparing a return for someone who, unfortunately, died in 2024. In this case, the taxpayer is considered age 65 at the end of 2024 if they were 65 or older on the day before their death. For instance, if the taxpayer was born on February 14, 1959, and passed away on February 13, 2024, they are considered age 65 at the time of death, and thus for the purposes of this credit. However, if that same taxpayer died on February 12, 2024, they would not be considered age 65 at the time of death or at the end of 2024, so they'd be ineligible based on age. Precision is absolutely key with these dates.
Okay, this next section, for those under 65, introduces a fascinating layer of complexity. It's truly where the deep dive earns its name, I think, because the criteria are so specific. What if you're under age 65? What conditions need to align for someone to qualify based on disability?
Right, for those under 65, it's not enough to simply be disabled. There are 3 specific conditions that must all apply for you to qualify based on disability. First, you must have retired on what the IRS defines as permanent and total disability. We'll unpack that in a second. Second, you must have received taxable disability income for 2024. Again, specific definition there. And third, on January 1st, 2024, you must not have reached your mandatory retirement age. The IRS gives us a helpful tip here. You're generally considered to be under age 65 at the end of 2024 if you were born after January 1st, 1960. So yeah, it's a tight trifecta of conditions that have to be met simultaneously.
That definition of permanent and total disability sounds incredibly rigorous, especially with the substantial gainful activity part. What are some of the most common misunderstandings or pitfalls you see when people try to apply that definition to their own lives?
That's an excellent question, and it's definitely where many people stumble. Let's really deep dive into what permanent and total disability truly means in the eyes of the IRS. This is crucial for those under 65. It boils down to 2 core conditions that must both apply. First, you must be unable to engage in any substantial gainful activity because of a physical or mental condition. And this isn't just about, feeling unable to work. It's a very specific legal and medical determination. Second, a qualified physician must determine that this condition has lasted or can be expected to last continuously for at least a year, or that it can be expected to result in death. You'll need a physician's statement to back this up, which we'll definitely discuss when we get to part 2 of the form. So, what exactly is substantial gainful activity, or SGA? This is where the IRS gets really specific. SGA is defined as the performance of significant duties over a reasonable period of time while working for pay or profit, or in work generally done for pay or profit.
End unquote. The instructions are very clear.
If you're doing full-time work or even part-time work at your employer's convenience in a competitive work situation for at least the minimum wage, well, that conclusively shows you are able to engage in substantial gainful activity. In other words, if you're holding down a regular paying job, you're likely out of luck for this aspect of the credit regardless of your medical condition.
So it's not just about what you are doing, but what you could be doing, potentially, and the nature of that work. That sounds tricky.
Indeed. It's also important to understand what isn't considered SGA. This includes work you do to take care of yourself or your home, unpaid work on hobbies, institutional therapy or training, school attendance, clubs, social programs, things like that. These are generally considered personal or rehabilitative activities, not productive work. However, a critical nuance here is that the fact you haven't worked or have been unemployed for some time isn't by itself conclusive evidence that you can't engage in substantial gainful activity. The focus is on your ability to perform the work, not just whether you are currently employed or maybe you choose to be. To truly cement this concept, let's look at some illustrative examples directly from the IRS instructions. This is where the subtleties become clear and where, honestly, many misunderstandings arise. Okay, example 1. Alex, a sales clerk turned babysitter. Alex is 53, retired on disability from a sales clerk job, but now works full-time as a babysitter for minimum wage. Even though it's different work from their previous job, Alex is performing full-time work in a competitive situation for minimum wage. So the credit cannot be taken because Alex is still able to engage in substantial gainful activity. The key here is the nature and regularity of the new work. It's a consistent, paying job. This clearly illustrates that changing professions or roles doesn't automatically mean you no longer engage in SGA. Now, example 2. Blake, a bookkeeper turned truck driver for charity. Blake is 59, retired on disability as a bookkeeper, and now drives the truck for a charitable organization. Blake isn't paid and decides their own hours, working maybe 10 hours some weeks, 40 hours, others averaging 20 hours a week over the year. Even though it's unpaid and flexible, the kind of work and the average hours per week conclusively show that Blake is able to engage in substantial gainful activity. This is because duties of this nature are generally performed for pay or profit, even if Blake is choosing to do it for charity. So, Blake cannot take the credit. This highlights that gainful doesn't always mean paid in the moment, but work generally done for pay or profit is the key concept.
That's a crucial distinction. A lot of people might think unpaid work doesn't count, but it seems the IRS is looking at the type of activity, the potential for pay. Are there scenarios where someone is doing some activity but it doesn't disqualify them?
Absolutely, and this is where it gets even more nuanced. Consider example 3. Cameron, trial basis light duties. Cameron, retired on disability, took a job with a former employer on a trial basis just to see if the work was possible. This trial lasted 6 months, and Cameron was paid minimum wage. However, because of Cameron's disability, only light, non-productive make-work duties were assigned. The crucial distinction here is between gainful and substantial. The activity is gainful because Cameron was paid, but it wasn't substantial because the duties were non-productive. The instructions say that these facts by themselves don't show Cameron is able to engage in substantial gainful activity. So Cameron might still qualify. The work wasn't truly substantial. And then there's example 4. Dean, assisting relative off and on. Dean, retired on disability from being a bookkeeper, lives with a relative who manages motel units. Dean is 56 and helps the relative for maybe 1 or 2 hours a day, performing duties like washing dishes, answering phones, registering guests, maybe some bookkeeping. Dean can select the time of day when feeling most fit to work. This kind of work, performed off and on during the day at Dean's convenience, is not considered activity of a substantial and gainful nature, even if Dean is paid for it. The performance of these duties doesn't by itself show that Dean is able to engage in substantial gainful activity. So Dean might qualify. These examples clearly demonstrate that substantial gainful activity is a very nuanced concept. It focuses on the nature and regularity of the work performed, not just whether income is earned, and particularly on whether it's truly a competitive work environment.
It's almost like a financial obstacle course, isn't it? Every time you think you've cleared one hurdle, another appears. But knowing the terrain like we're mapping out now, that makes all the difference. And I understand there's also a special consideration for what's called sheltered employment. What's that about?
That's a great point, yes. Sheltered employment refers to certain work offered at qualified locations, like work centers certified by the Department of Labor, often called sheltered workshops, or hospitals, homebound programs, or VA-sponsored homes. These are specifically for physically or mentally impaired persons. Typically, the pay for sheltered employment is lower compared to commercial employment because it's not really a competitive work environment in the traditional sense. The important point here is that the fact someone has accepted sheltered employment is not considered conclusive proof of their ability to engage in substantial, gainful activity. This means accepting such employment won't automatically disqualify you from the credit if you meet the other criteria. It's sort of a recognition that this type of work serves a different purpose than traditional employment. Okay, moving on to the taxable disability income requirement for those under age 65. If you're under 65, not only must you be permanently and totally disabled, but you must also have received taxable disability income during 2024. This income must meet two specific requirements.
First, it has to be paid under your employer's accident or health plan or pension plan. And second, it must be included in your income as wages, or payments instead of wages, for the time you are absent from work due to your permanent and total disability. This is about ensuring the income you're receiving is specifically tied to your disability, as recognized by your employer.
So it's not just any income, but income specifically designated as disability pay from an employer's plan. That makes sense for the targeted nature of the credit. Are there types of payments that might seem like disability income but actually don't count for this credit?
Absolutely. And this is another area where taxpayers can get tripped up easily. The IRS states that any payment you receive from a plan that doesn't specifically provide for disability retirement isn't considered disability income for this credit. Additionally, any lump sum payment you might receive for accrued annual leave when you retire on disability, that's treated as a salary payment, not disability income. And finally, there's the mandatory retirement age detail we mentioned earlier. For the purposes of this credit, disability income doesn't include amounts you receive after you reach your mandatory retirement age. This is defined as the age your employer would have required you to retire had you not become disabled. So any payments after that point, even if they are disability related, don't count towards the taxable disability income for this specific credit. It's about distinguishing genuine disability income from what would be considered regular retirement income.
So after navigating all those eligibility hurdles, U.S. residency, age, or that very specific definition of disability, and specific types of income, what does this all mean for actually filing your taxes and claiming this credit? There are some very specific filing status restrictions too, correct?
That's right. The IRS has clear rules here, probably to prevent, gaming the system. Generally, if you are married at the end of the tax year, both you and your spouse must file a joint return to take this credit. This is a pretty common requirement for many tax benefits, designed to ensure a holistic view of the household's income.
But there are always exceptions with the IRS, right? What's the carve-out for married individuals here?
There's a narrow exception for married persons filing separate returns. If your filing status is married filing separately and you lived apart from your spouse at all times during 2024, then you can claim the credit. But here's the crucial point. If you lived with your spouse at any time during 2024, even for just a single day, and you file separately, you simply cannot take this credit. It's an all-or-nothing rule for married filing separately to ensure genuine separation. There's also an interesting exception for those who might file as head of household. You can file as head of household and qualify to take the credit, even if your spouse lived with you during the first 6 months of the year, provided you meet all 5 of these specific tests. First, you must file a separate return. Second, you must have paid more than half the cost of keeping up your home during the tax year. Third, your spouse must not have lived in your home at any time during the last 6 months of the tax year, and their absence couldn't have been temporary. Fourth, your home must have been the main home of your child, stepchild, or an eligible foster child for more than half the year.
And an eligible foster child is specifically defined placed with you by an authorized agency or court order. And fifth, the child must be your dependent, or would be your dependent, except that the non-custodial parent gets to claim them under those special rules for divorced or separated parents. For more details on the head of household rules and dependent tests, you definitely want to check Pub 501. That's the IRS Tax Guide for Dependents, Standard Deduction, and Filing Information. These rules are very, very specific, and missing even one detail can disqualify you.
So it's not just about your personal situation, but your entire household structure and how you choose to file. Finally, a quick but important note on the form itself. You can only take the credit if you file Form 1040 or Form 1040-SR. You absolutely cannot take this credit if you are filing Form 1040-NR, which, as we mentioned, is for non-resident aliens. So if you're a non-resident alien not making that specific election to be treated as a resident, this credit just isn't available for you. Okay, now that we've navigated the tricky waters of eligibility and determined if we might qualify, let's look at the form itself, Schedule R. The good news is the IRS can actually figure this credit for you, if you prefer, but understanding it yourself truly gives you power and confidence in your tax filing. If you want the IRS to figure it, you just check the appropriate box in Part 1 of Schedule R, fill in Part 2 if it applies to you, and lines 11 and 13 of Part 3. Then you'd write CFE on Schedule 3, Form 1040, line 6PAM, and of course you'd attach Schedule R to your return. But we're going to walk through how to do it yourself, giving you that full understanding.
All right, let's dive into the specifics of filling out Schedule R, starting with Part 1. Checking your box for your filing status and age. This is the absolutely critical first step on the form because your selection here dictates so much of the rest of the calculation. You must check only one box. There are 9 boxes in total, corresponding to different filing statuses and age disability conditions for you and, if applicable, your spouse. Instead of listing all 9 boxes verbatim, let's just group them conceptually. Essentially, Part I is your self-identification step. You choose the box that accurately reflects your filing status: single, head of household, qualifying surviving spouse, married filing jointly, or married filing separately. And then which members of your household, including yourself, meet either the age 65 plus criteria or the under 65 permanent and total disability criteria. For example, boxes 1 and 2 are for single filers, depending on whether you're 65 or older or under 55 and disabled. Boxes 3 through 7 cover various combinations for married filing jointly, whether both are older, both disabled, or a mix. And boxes 8 and 9 are for married filing separately, but only if you lived apart all year, again based on age or disability. The form is really designed to funnel you directly to the next relevant section based on this crucial first choice.
So it's really like a diagnostic tool guiding you through the form. Once you check that box in Part 1, what's the immediate next step based on that choice? Where does it send you?
Right. Once you check the appropriate box in Part 1, the form then tells you your immediate next step. If you check box 1, 3, 7, or 8, you get to skip Part 2 entirely, which is a nice little time saver. Otherwise, if you check boxes 2, 4, 5, 6, or 9, you must complete Part 2. So choosing the correct box here is absolutely foundational to accurately determining your eligibility and moving through the rest of the form correctly. It's the decision point that funnels you down the right path for your specific situation.
Excellent. So if you didn't get to skip ahead from Part 1, then you're moving on to Part 2. The statement of permanent and total disability. This section is critical, but only for those who checked boxes 2, 4, 5, 6, or 9 in Part Assimility. Essentially, anyone claiming the credit based on a permanent and total disability. What's the core requirement here? What do you need?
The key requirement here is that you need a physician's statement. This statement certifies that you are permanently and totally disabled on your retirement date. Or, if you retired before 1977, you are permanently and totally disabled on January 1st, 1976, or January 1st, 1977. It's all about documenting that the disability qualifies per IRS rules.
Now, here's a crucial detail that saves you from a lot of paperwork, right? You don't actually file this physician's statement with your tax return. Instead, you must keep it for your records, just in case the IRS ever asks for it. The Schedule R instructions even include a sample physician's statement form that your doctor can use. They should indicate whether your disability is expected to last for at least a year or if there's, no reasonable probability of improvement. And if you're filing a joint return and you check box 5 in Part I, both disabled, both you and your spouse must each get a separate statement.
That's right. It's a relief to know you don't have to submit it every single year.
Definitely. Is there an exception for subsequent years if your condition is truly permanent?
Yes, there's an important exception that can simplify things even further down the road. If you filed a physician's statement for 1983 or an earlier year, or if you filed or obtained a statement for tax years after 1983 and your physician signed on line B of that statement, that line B specifically signifies no reasonable probability the condition will ever improve, end quote. If that's the case, then you don't need to get a new statement for 2024. This is a fantastic bit of tax savings just by reducing the administrative burden. Instead, you just check the box on line 2 in Part 2, and by doing so, you're certifying 3 things. First, that you filed or got a physician's statement in an earlier year. Second, that you were permanently and totally disabled during 2024. And third, that you are unable to engage in any substantial gainful activity during 2024 because of your condition. It's basically a certification that your disability status hasn't changed, making it much easier to claim the credit in subsequent years without needing new medical paperwork every time.
And what if someone's disability is certified by the VA? Does that process differ? Is there an alternative?
Yes, there's an alternative for veterans. If the Department of Veterans Affairs VA certifies that you are permanently and totally disabled, you can use VA Form 210172 instead of the physician's statement. This form needs to be signed by a person authorized by the VA to do so, and you can obtain it from your local VA regional office. Again, just like the physician's statement, remember to keep it for your records. Don't file it with your return.
This section really emphasizes the importance of documentation, but it also offers a pathway to avoid repeated trips to the doctor if your condition is already established as permanent. It definitely streamlines the process for those who qualify. All right, now we arrive at part 3, figuring your credit. This is truly where the magic happens for your potential tax savings, but it's also where the initial credit amount can be significantly reduced or, frankly, even eliminated based on your income. To begin, you need to determine your initial amount using lines 10 through 12. This initial amount is essentially the starting point for your credit calculation. It depends on your filing status and, if you're under age 65, the amount of your taxable disability income.
For qualified individuals under age 65, your initial amount can't be more than your taxable disability income. So your initial amount would be the lesser of the amount shown for your filing status on line 10 or your taxable disability income figured on line 11. This smaller amount then goes on line 12. Let's quickly review line 10, initial amount. The instructions provide a clear table for this. If you check box 1, 2, 4, or 7 in Part I, you enter $5,000. If you check box 3, 5, or 6, you enter $7,500. And if you check box 8 or 9, you enter $3,750. This sets the baseline for your credit before any of the reductions kick in.
That's the maximum starting point. What about line 11? Taxable disability income. This seems particularly relevant for those under 65, as you mentioned.
Absolutely. This line is only for those who check boxes 2, 4, 5, 6, or 9 in Part I. Essentially, anyone who is under 65 and claiming the credit based on disability. Here's how you figure it out based on your specific situation. If you check box 6, married filing jointly, one spouse 65 plus and the other under 65 disabled, you add $5,000 to the taxable disability income of the spouse who was under age 65. If you checked box 2, 4, or 9, single HHQSS under 65 disabled, or married filing jointly with one disabled spouse, or married filing separately with one disabled spouse, you simply enter the total amount of taxable disability income you reported on your tax return. If you check box 5, married filing jointly both under 65 and both disabled, you add your taxable disability income to your spouse's taxable disability income and enter the combined total. The instructions emphasize that this income is the amount you reported on your Form 1040, line 1 hour. This step ensures that for disabled individuals under 65, the credit is directly tied to their disability income. Okay, after line 11, we go to line 12, determining the lesser amount.
If you completed line 11, you'll enter the smaller the amount from line 10, your initial base amount, or line 11, your taxable disability income. If line 11 wasn't applicable to you, meaning you're 65 or older, and didn't need to calculate disability income, then you just enter the amount from line 10. This ensures that for those under 65, the credit amount doesn't exceed their actual taxable disability income. It provides that direct link between their qualifying income and the potential tax benefit.
So that's our starting point, our initial amount on line 12. But this credit, like so many others, isn't a free ride for everyone who meets the basic criteria. It comes with reductions. Let's talk about lines 13A through 13C, the reduction for non-taxable income. This raises an important question for many people. Why on earth did they reduce a credit based on non-taxable income? That seems counterintuitive.
That's an excellent question, and it's something that often surprises people. You're right. The reason isn't arbitrary, though. It's rooted in the policy goal of this credit. It's partly about preventing double dipping and ensuring the credit is truly targeted to those most in need. If you're already receiving significant government benefits that aren't taxed, the credit gets adjusted accordingly. It means this credit is really aimed at those with a demonstrated financial need, rather than being a universal benefit for anyone over 65 or disabled. For many, this part of the calculation is where the credit often gets significantly reduced or even completely eliminated. So understanding this policy decision is key to not being surprised by your final outcome. Specifically, on line 13A, you'll enter any non-taxable Social Security benefits you and your spouse, if filing jointly, received for 2024, and that's before any deduction for Medicare premiums. You also include any non-taxable Tier 1 railroad retirement benefits that are treated just like Social Security. The instructions are very clear.
If your Social Security or equivalent railroad retirement benefits are reduced because of workers' compensation benefits, you must treat those workers' compensation benefits as Social Security benefits when completing line 13A. Also, don't include lump sum death benefit payments or surviving child insurance benefit payments here. Then on line 13B, you'll enter other specific types of non-taxable income that count toward this reduction. Primarily certain veterans' pensions, but importantly, not military disability pensions. Those are treated differently. And any other pension, annuity, or disability benefit that's excluded from income under a federal law outside the IRS tax code itself. The key takeaway here is to ensure you're including all those untaxed government benefits that are designed to support you, as they factor into the IRS's calculation of your overall financial picture for this credit. However, be careful not to include amounts that are simply a return of your cost of a pension or annuity, or any pension annuity allowance for personal injuries or sickness from active service in the armed forces, NOAA, or public health service.
or disability annuity under Section 808 of the Foreign Service Act of 1980. The IRS cautions you to be sure to take into account all of the non-taxable amounts you receive, as they apparently verify this through information supplied by other government agencies. Finally, line 13C is simply the sum of lines 13A and 13B. This is the total amount of non-taxable income that will reduce your potential credit. Again, it's critical to remember that even though these income items aren't taxable, they must be included here to figure your credit accurately. If you didn't receive any of these types of income, you just enter 0 here.
So we've potentially reduced the credit amount for certain non-taxable income, but the IRS also looks at your overall income picture, your taxable income. Let's talk about lines 14 through 17, the reduction for excess adjusted gross income, AGI. Well, what's happening here? How does this work?
Right. After accounting for non-taxable income, the credit can also be reduced if your adjusted gross income, or AGI, is over certain limits. This is essentially a phase-out mechanism. Think of it like a sliding scale. The higher your income goes beyond these specific thresholds, the less of the credit you're eligible for. It's the IRS's way of ensuring this specific benefit primarily aids lower and middle-income individuals who meet the age or disability criteria rather than those with substantial other earnings. Line 14 is straightforward enough. You'll simply enter your AGI directly from Form 1040 or 1040-SR, line 11. Line 15 introduces the AGI thresholds. These are the income limits that determine if your AGI will reduce your credit. The amounts vary by filing status. If you check box 1 or 2, single HHQSS, the threshold is $7,500. If you check box 3, 4, 5, 6, or 7, married filing jointly, the threshold is $10,000. And if you check box 8 or 9, married filing separately, the threshold is $5,000. These amounts are key to knowing if your income is too high to take the credit, or at least if it will significantly diminish it. It's a very precise income targeting mechanism.
Line 16 requires you to subtract the AGI threshold from line 15 from your actual AGI on line 14. If the result is 0 or less, you just enter 0. This means your AGI is below the threshold, and you won't have any reduction from this particular component. Then on line 17, you enter 1/2 50% of the amount from line 16. This is where the AGI reduction truly kicks in. For every dollar your AGI exceeds the threshold, your potential credit base is reduced by 50 cents. It's a calculated face-out designed to limit the credit to lower and middle-income individuals. Line 18 then aggregates your total reductions. You add the non-taxable income reduction from line 13C and the AGI reduction from line 17. This sum represents your total reduction amount. Okay, now line 19, preliminary credit amount. You subtract your total reductions, line 18, from your initial credit on line 12. This is the critical stopping point. If the result is 0 or less, you cannot take the credit, full stop. If that's the case, you stop right there. Your reductions have completely negated any potential credit. This is where many people find out if the credit will actually benefit them or not.
If you still have a positive number on line 19, then you move to line 20. Here, you multiply that preliminary credit amount by 15%, or 0.15. This is the actual credit rate, determining the final amount you might be able to claim before any final limitations. Line 21, credit limit. Even if you made it this far, there's one final hurdle. The amount of credit you can claim is generally limited to your actual tax liability. The instructions provide a credit limit worksheet for this purpose. In essence, you take your total tax from Form 1040 or 1040-SR, line 18. Then you subtract certain other non-refundable credits listed on Schedule 3, Form 1040, specifically lines 1, 2, and 6. The result is your maximum allowed credit. This ensures the credit doesn't reduce your tax below 0 if you don't owe any tax to begin with, or that it doesn't exceed the amount of tax you actually owe. It's a fundamental principle of non-refundable credits. Finally, on line 22, final credit, you enter the smaller of the amount calculated on line 20, your credit before the limit, or line 21, your credit limit. This is your final tax-saving credit.
And don't forget, you must also enter this amount on Schedule 3, Form 1040, line 6 PIN, to make sure it's actually applied against your tax liability. As you can see, it's definitely a multi-step calculation, but each step serves a very specific purpose in determining who truly qualifies for this valuable tax break and exactly how much they can claim.
That breakdown really clarifies the impact of those reduction factors. It definitely seems like the preliminary credit on line 19 is where many people's hopes for this credit either solidify or get completely dashed, doesn't it? The theory is one thing, but seeing how these numbers play out in real scenarios, as we will now, is where I personally find the insights really click into place. Let's look at a couple of examples directly from the IRS instructions to solidify how all these pieces fit together.
Good idea. This was example 1. Jesse, single, disabled, gets the credit. Jesse's 58 years old, single, and files Form 1040. Jesse retired on permanent and total disability back in 2022 and is still permanently and totally disabled. Jesse obtained the required physician statement in 2022, and crucially, the physician signed on line B of that statement, certifying no reasonable probability the condition will ever improve. So for 2024, Jesse just checks the box in Schedule R, Part 2, meaning no new statement is needed this year. Now, for Jesse's income details, Non-taxable Social Security, $700. Taxable interest, $100. Taxable disability pension, $15,000. So Jesse's adjusted gross income AGI from Form 1040, line 11, is $15,100. That's the $100 taxable interest plus the $15,000 taxable disability pension. Okay, let's walk through Jesse's Schedule R calculation line by line so you can see how each piece of income in each rule we just discussed plays out. 1 line 10, initial amount based on filing status. Jesse single, so we enter $5,000. 2 line 11, taxable disability pension. Jesse received $15,000 in taxable disability pension. 3 line 12, initial amount smaller of line 10 or 11.
The smaller of $5,000, $15,000 is $5,000. This is the maximum base for the credit. 4. Line 13C, non-taxable Social Security benefits. Jesse received $700 in non-taxable Social Security. 5. Line 17, excess adjusted gross income reduction. Jesse's AGI is $15,100. The AGI threshold for single filers is $7,500, so we calculate $15,100, $7,500 divided by 2. That's $7,600 divided by 2, which equals $3,800. 6 cents. Line 18, total reductions add lines 13C and 17. $700 non-taxable SS plus $3,800 excess AGI reduction equals $4,500. 7 cents. Line 19, preliminary credit subtract line 18 from line 12. Here's a critical point. $500 from line 12 minus 0.155 equals $500. This is the credit amount before the final tax liability limit. 9. Line 21, credit limit worksheet amount. From the credit limit worksheet in the instructions, let's say Jesse's actual tax liability limit is calculated to be $51.10. Line 22, final credit smaller of line 20 or 21. The smaller of $75 or $51 is $51, so Jesse can claim a credit of $51.
Jesse then enters $51 on Schedule R, line 22, and also on Schedule 3, Form 1040, line 6P, and attaches the completed Schedule R. Jesse qualifies and gets a credit because even though Jesse has some non-taxable Social Security and an AGI that causes a reduction, the initial credit amount of $5,000 is not completely eroded by the total reductions of $4,500. There's still that $500 left before the 15% calculation, leading to that $75 credit, which is then just capped by the actual tax liability. This example demonstrates that even with income and non-taxable benefits, you can still potentially get a credit, although it might be reduced quite a bit. It shows the precise impact of those reduction factors.
That's a great illustration of how the numbers flow and how important it is to go through every single step meticulously. Now let's look at another example. Example 2. Riley and Parker, married, both disabled, don't get the credit. This one will show us how quickly those reductions can eliminate the benefit entirely, even for individuals who seem perfectly qualified based on disability. Okay, Riley's 53 years old and Parker's 49. Riley had a stroke 3 years ago and retired on permanent and total disability and is still permanently and total disabled. Parker was injured in an accident at work back in November and also retired on permanent and total disability. They are married and filing jointly. Parker's doctor completed the physician's statement for 2024. Riley had already gotten a physician's statement when the stroke occurred, and that doctor signed line B on that statement certifying permanent and total disability. So Riley just checks the box on Schedule R, Part 2, like Jesse did. Here's their income breakdown. Riley's non-taxable Social Security disability benefits, $2,000. Riley's taxable disability pension, $6,400. Parker's job income, presumably from before the accident, $21,250. Parker's taxable disability pension, $1,700. Their joint AGI, Form 1040, line 11, is $29,350. That's adding up Riley's $6,400 pension, Parker's $21,250 job income, and Parker's $1,700 pension. Let's see how they fare on Schedule R, stepping through the same calculation. 1, line 10, initial amount based on filing status. They're married filing jointly, both disabled, so we enter $7,500. 2, line 11, taxable disability pension for both spouses. Riley's $6,400 plus Parker's $1,700 equals $8,100. 3, line 12, initial amount smaller of line 10 or 11. The smaller of $7,500, $8,100 is $7,500. Line 13C, non-taxable Social Security benefits. Riley received $2,000, 5 cents. Line 17, excess adjusted gross income reduction. Their AGI is $29,350. The AGI threshold for married filing jointly is $10,000. So we calculate $29,350, $10,000 divided by 2. That's $19,375. Excess AGI reduction equals $11,675 reduction.
Now, this is where critical thinking comes in, and we see exactly why Riley and Parker are ineligible, despite both being permanently disabled. On line 19, preliminary credit, we need to subtract line 18, $11,675 from line 12, $7,500. When you do that calculation, $7,500 minus $11,675, the result is negative. It's $4,175. The instructions explicitly state that if line 19 is 0 or less, you cannot take the credit. Riley and Parker's total reductions from their non-taxable Social Security benefits and their excess adjusted gross income, $11,675, far exceed their initial credit amount, $7,500.
This vividly illustrates how the income limits and the reduction for non-taxable benefits can completely negate the credit, even if you otherwise meet the qualified individual criteria, like being permanently disabled. They did all the right steps to be considered disabled, they got the documentation, but their combined income simply pushed them out of eligibility for this specific tax-saving credit. This example really drives home the point that while the credit can be a great benefit, its eligibility is very finely tuned to income levels. It's not automatic.
Wow, those examples truly make it crystal clear how the numbers work and, maybe more importantly, why someone might or might not qualify. Even with seemingly similar situations regarding age or disability, it's all about those specific income thresholds and those sometimes surprising reduction factors. So, to recap this deep dive into the credit for the elderly or the disabled, IRS Schedule R, we've seen it can be a significant tax-saving tool, directly reducing your tax liability dollar for dollar. However, eligibility is highly specific. It requires meticulous attention to your age, your disability status, if applicable, your U.S. residency, your filing status, and crucially, those income limitations. Remember how the non-taxable income and the adjusted gross income can quickly reduce or even completely eliminate the credit? It's all in those precise details. And understanding them really empowers you to maximize your tax savings if you do qualify.
Exactly. And if we connect this to the bigger picture, understanding the why behind these rules is also key. The reductions for non-taxable income and excess AGI aren't just arbitrary hoops to jump through. They're designed to ensure the credit genuinely targets individuals who are most in need of that specific financial assistance. It's about balance and ensuring the benefit goes to its intended recipients based on their overall financial picture. I really encourage you, if you think this might apply to you or someone you know, to revisit the Schedule R instructions, armed with this deeper understanding, and apply it carefully to your own specific financial situation. Knowing these details can empower you to correctly claim the credit if you're eligible, or, just as importantly, to understand why you might not be, saving you time and potential frustration.
Absolutely. And given the precise nature of these tax credits and how they're structured to provide such targeted relief, it really makes you wonder, what other overlooked tax forms or schedules might hold unexpected savings or maybe hidden complexities that are worth a deeper dive for you? There's always more to learn in the world of taxes, isn't there? And often those hidden gems are just waiting to be uncovered, offering surprising avenues for financial benefit if you know where to look. That's all the time we have for this deep dive today. We really hope you feel much more informed and empowered to tackle Schedule R, or at least understand its intricacies better. Until next time, keep digging for that knowledge.